All right, welcome to Talk Tickers. Today, we're tearing down Lamb Weston's first quarter earnings. Now, the stock did get a nice little pop after the report, but believe me, that headline number does not tell the full story. So, let's get into it.
And here it is. This is the number that got the market moving. Adjusted earnings per share came in at 74 cents. Now, to put that in perspective, the consensus on the street was closer to 55 cents. So yeah, this was a pretty significant beat. And in a market that's just desperate for good news, Lamb Weston definitely delivered.
But, the stock's reaction, a solid but not exactly blockbuster 4.3% gain, really tells you everything you need to know about the quarter's internal tug-of-war. It's fascinating, really. On one side, you have this really impressive 6% volume growth and great cash flow. But on the other side, that growth was completely wiped out by a 7% drop in what we call price/mix. And then you had this ridiculously high effective tax rate of almost 43% that just took a huge bite out of the bottom line. It's a classic story. They're executing really well operationally, but they're running straight into some tough market headwinds.
Okay, so let's peel back the layers on that volume versus price dynamic, because honestly, it is the single most important part of this quarter story. And this chart just lays it out perfectly. Lamb Weston is selling more French fries, a lot more, 6% more to be exact. And that's being driven by some big new customer wins. Great news, right? Well, yes and no, because to lock in that volume and to help out their partners in what's a pretty tough environment, they had to make some deliberate price cuts and trade investments. And that's exactly what's driving that negative 7% you see in price/mix.
So here's the kicker. After all that work, all that impressive growth in volume, what happened to the top line? Basically nothing. It came in essentially flat. The plus 6% and the minus 7% just completely canceled each other out, leaving revenue sitting at just under $1.7 billion. So let's see how this all shook out in their different business units. If you look at the table, profitability in North America actually went down by $18 million. Why? Because those price investments more than erased all the benefits they got from selling more volume. The international business, though, that saw a nice little bump. But, and this is a big but, you gotta remember this was largely because of an easy comparison. Last year they had a big charge from a product withdrawal, so they were lapping a really weak quarter.
So, you're facing this environment. You've got strong demand, but you're getting squeezed on price. What's the game plan? Well, management is rolling out a brand new program they're calling Focus to Win, and it is all about efficiency and controlling costs.
Now listen up, because this right here is the heart of the bull case for the stock. Management has given us a very clear, multi-year plan to pull costs out of the business. We're talking at least $100 million in savings by the end of this fiscal year. And on top of that, another $60 million from managing their working capital better. And the long-term goal? To hit a run rate savings of over $250 million by fiscal 2028. This is the main lever they're going to pull to get those margins higher. And to really hammer the point home, the CEO, Mike Smith, said it very clearly on the call. He said, "We are acting with urgency. This is not a let's wait and see kind of thing." The message to all of us on the outside was crystal clear. Executing this cost-saving plan is priority number one, period. And look, it's not just about cutting costs. They're also playing offense. The demand for their products in North America is actually so strong that they're firing up a production line that they had previously shut down. Their new factory in Argentina is officially online and serving South America, and they're even reorganizing their sales teams to go after new types of customers.
Okay, so with a pretty decent quarter in the rearview mirror and a new plan kicking off, what does the rest of the year actually look like? Let's get into the official guidance and the overall vibe from management.
Now this is where it gets interesting. Even with that big Q1 beat, management decided to just reaffirm, not raise, its full-year guidance for sales and profits. Now that's a smart move. It tells you that while Q1 was good, they're not getting carried away, especially since they expect that pricing pressure to stick around for a little while. They did make one little change, though, slightly bumping up their expected tax rate for the full year to between 26 and 27%. So if you had to boil down the tone of the entire call into two words, it would be cautiously bullish. Management is clearly confident they can keep driving volume and that they can deliver on their big Focus to Win plan, but they were also super realistic, They acknowledge the pricing competition, especially over in Europe, and the fact that traffic at fast food restaurants is still pretty choppy. All right, that was the quarter that was. Now it's time to pivot and look forward. This is The Next Call, our official house view on where Lamb Weston is headed from here. So, after digesting the numbers and listening to the commentary,
What's our final call on the stock? We're initiating coverage with an outperform rating. Bottom line, we think the market is seriously underestimating the margin improvement story that is just getting started here.
So here's the trade idea. We're long the stock, and the thesis is really simple. That Focus to Win program is for real. As those savings start to flow through the income statement, it's going to drive margin expansion that just isn't priced into the stock today. What are we watching for? Well, we need to see those savings numbers come through each quarter. We're looking for signs that pricing is getting better in the second half of the year, and we need a smooth ramp up of their new production capacity. Now, what's the big risk? It's the economy. If the consumer really starts to pull back and traffic at quick service restaurants, especially the big US burger chains, takes a nosedive, that could put their whole volume story at risk.
This is not financial advice.